We've been at it for just under 4 years. Today we have about 100 locations, mostly in the Southeast, but also Texas, Midwest. We're in 9 states. We have deals in 14 additional states. Across the whole portfolio, we have about 850 employees. Depending on how you measure revenue, we're between 150 and 200 million in revenue. And we're growing very quickly. I have a lot of thoughts about search funds, mostly negative, but I think that search funds are fundamentally not scalable. I mean, the whole idea is that 1 or 2 people go through fundraising, then they go through deal sourcing, they go through deal negotiation, and they raise debt, and you learn a lot of lessons along the way, and then you don't use them again.
Logan, thanks for joining the show. It's great to have you.
Happy to be here.
So you have a fascinating background. You've worked through a variety of different industries, including the armed forces, and now rolling up a lot of businesses. Tell us a little bit about where you are today with your current business, any sense of scale that you think would be interesting for listeners, and then we'll dial the clock backwards and we'll look at your background and get caught up till today.
Yeah, sure. So the main thing we do right now is Main Street Automotive. And so we buy and operate large independent automotive service repair shops. We've been at it for just under 4 years. Today we have about 100 locations, mostly in the Southeast, but also Texas, Midwest. We're in 9 states. We have deals in 14 additional states. Across the whole portfolio, we have about 850 employees. Depending on how you measure revenue, we're between 150 and 200 million in revenue. And we're growing very quickly. So anytime we throw numbers out there, it's usually, we usually pass that the time, the point at the point of airing,
That's awesome. That's really incredible, rolling up 100 different locations. I want to ask you all about that, but tell me a little bit about how you got into this. What's your background? What's been your career so far?
Yeah, so military background originally. So joined the military out of high school, did just over 8 years on active duty. Then went to college at 26. So, did it a little backwards, I'd say. Went to college, got exposed to business because at that point in my life, my entire adult life had been in the military. Don't really have business experience in the family growing up. So hit the ground at 26, not really knowing much about anything other than military. And then went right into a joint law and business program and had several summers to intern and to be exposed to different businesses and finance and operations. Really like deals, really like finance and investing. So, but didn't want to work in any of those firms for a lot of reasons, but mostly just culture and fit. And that's really important to me. And I think a lot of people don't think as much about that as they should. And so decided to start my own business. Really like leading people and doing operations. And the only way to do that and still have a finance focus is what I'm doing now. And we started off as a holding company concept. So even though that entity didn't hold anything to begin with, but looked at doing multiple acquisitions in different industries, pivoted to what we're doing now, which is a strong focus in one industry. Picked automotive as the focus for a lot of reasons, and just started doing deals and started building the team, building the corporate engine behind it, and it snowballed and got to where we're at today.
If you run a holding company or business with multiple entities, you should definitely listen to this. At Enduring Ventures, we have over 50 bank accounts across our different portfolio companies. Our director of finance, Nick, spends every morning going through those accounts one by one and making sure that the cash balance is where he expects it to be. This used to take him an hour or so every single day. There really wasn't an easier way to do it. Then a friend of mine introduced me to Vesto. Vesto makes it easy to connect all of your bank accounts into a simple dashboard, so you get real-time balances, transactions, and cash flow monitoring, all in one place, with just one login. So Nick got to go from checking 50 different accounts to just checking one account and one dashboard every single day. A job that used to take Nick almost an hour every day now takes him just a couple minutes or less. If you're managing multiple bank accounts, Vesto is a no-brainer. Go to vesto.com, tell them that Sieva sent you, and you'll get to speak directly to the founder, Ben.
What inspired you to start that holdco? Because it doesn't sound like you came through kind of traditional private equity, which is what I'm used to seeing.
Yeah, I think learning about search funds and that in school, and I have a lot of thoughts about search funds, mostly negative, but I think the positive aspect of it is there's a lot of opportunity to drive value. You can take people with high talent and access to capital and have a really good outcome in some of these undercapitalized and undermanaged industries. And but I didn't want to be tied in down to one. I think that search funds are fundamentally not scalable. I mean, the whole idea is that one or two people go through fundraising, then they go through deal sourcing, they go through deal negotiation, and they raise debt, and you learn a lot of lessons along the way, and then you don't use them again because you're not doing once you've raised the financing, you typically don't in a search fund raise more financing. Once you acquire a business, typically don't acquire another business for a long time. And then you get into the operations, and you do that for 5 to 7 years and try to look for an exit. That all seems interesting, but I wanted to take the good elements of that and scale it. And so the holdco concept was to try to find at the time it was try to find senior military veterans that I knew would be really good at leadership and ops, very light on the business experience, but we could support that at the holdco level and try to do multiple search fund esque type deals. That first thesis didn't really work out for a number of reasons, and so that's why we pivoted to what we're doing now, which is me as the top, not trying to hire an operator between me and the business, and then just doing the same thing over and over again, which is what a roll up is. You get really excellent at the fundraising, sourcing the deals, getting the deals done, transitioning them, and operating them, and you do it 100 times. And by the time you get to 100, you should be really really good at it. And then you take those skills and you get to 1,000. That's what that's the strategy that we're doing now.
Yeah, as I reflect on all the acquisitions that we've done, the ones that didn't go well are definitely the ones that I learned the most from. For some reason, I'm not sure, but they're the ones that are perhaps like etched in blood in my skin
Yeah.
permanently and in my brain. So I'll remember those forever. What were some of the lessons that you learned trying to do your hold co? You mentioned some things didn't work out. What were some of the observations that you probably ported over to your current business?
Well, I think there's a lot that we experienced that was only because of that moment in time. That so in 2018 was when I launched. The economy was ripping. People were kind of expecting a recession at some point, but it just every year it just wasn't happening. Multiples were really high, and so we were going out, and these were all brokered deals, and there was not a lot of value at the buy. So that was in that moment of time was really tough. So we would have to overpay for businesses in that period. So that was a problem. If we actually had consummated some deals, we didn't know at the time. It would have been really challenging to try to move up the learning curve in multiple industries in multiple businesses. So if you take something like automotive that we're doing now, on its face it seems like it's a pretty simple business model. We're still learning stuff 4 years in, and anytime we learn something, we can apply that learning to 100 shops, right? And anytime we make a mistake on one, it's only a mistake at one shop, and that scalability, that kind of leverage on your learnings is really only you can really only do that if you're focused on one industry, one type of deal. Um, so you can't really do that. I think in a holdco if you have multiple acquisitions in different industries. We focus a lot on just scalability. So and that was even before we bought the first shop. And everything we do, processes, procedures, data infrastructure, talent, it's when we had zero shops, it was how do we put something in place or come up with something or start working on something that we could roll out to 1,000 shops, and then you kind of grow into that leverage. I think that's a lot more difficult on a traditional holdco structure.
Yeah, we get asked that quite a bit because we're business agnostic. So people say, you're missing quite a bit of the leverage and the opportunity that you do of actually going deep on a business, which is why I love talking to you and folks who've gone vertical, who've gone deep, because that's really where you can develop a truly unique advantage. And like you said, go fast, right? Reproduce
For
a
sure.
model that's working for you. So let's dive in. How did you discover the auto industry, and of all the different industries out there, why did you pick that as your first business and now your platform?
Yeah. So when I decided to focus on a consolidation or a roll up, I did look at different, variety of different industries. I think they're all at least close to the same attractiveness with a strategy like this. So it really came down to fit. Um, I've worked, across internships, across some other jobs. I've worked in different types of businesses, and you're not going to get the best me in certain industries, tech, for example, or it's just being really it's a process of self discovery for one, and then being really honest with yourself because you can't do it all. Not everything's a right fit for you. And it doesn't have to be the same fit as someone else that you know or you look like. And for me, the blue collar skilled trades are just a good fit for like the type of person I am, like how I grew up, my military background, and so auto looked like that. So when I started really digging into auto and meeting the people that are in shops, meeting the sellers of these businesses, people that have founded it 20 years ago and have ran it. To me, it's just like my kind of people. I know how to talk to those people. I know how to connect with them. I totally appreciate their lifestyle. And I think I could have that connection in other ones, but this one was just felt like the strongest fit.
Yeah. Have you ever repaired a car before you got into this?
Yeah, my own when I had to. Yeah, yeah.
Okay,
I mean,
that's
I meet a lot of you know the quickest way to make an interest, to ruin an interest of yours is to make it a job, or to do it if you have to do it. So I meet a lot of people that like working on their cars, and it's a release. It's a good hobby, but having some scar tissue when I had no money and trying to get my car working or my motorcycle working, that's a different vibe. So I don't think I'm quite recovered from that, but I had the basic expertise down.
okay. That's better than me. I think I've installed two parts on my car: the radio once, and then the runner boards. And I messed up on the latter. So that's kind of my level of handwork experience. What did you observe? I'm sure you looked at a bunch of different auto shops or a bunch of different types. There's obviously franchises, non-franchises. There's ones that probably more so specialize in serving like commercial providers or rental car companies, or there's ones that are focused on luxury or not. What did you observe in the different types of providers that either drew you or pushed you away?
Yeah, I think a lot, right? So there's again back to what's scalable. What can we? What I didn't want to do is have different locations with different revenue mixes, different products. At least on the onset. So I looked at general service and repair. So nothing specialized. Things that were just retail customers, nice broad customer base, and that's what we bought. That's the biggest percentage of the market. Now you have Euro, you have more fleet business focused shops, and we introduced those things into the portfolio now that we have some size. So we do have a Euro one, couple Euro shops, and it's easier to manage that when you have a bigger base of a portfolio. So for if we had bought a Euro shop to begin
Is
with,
Euro Shop just like a European car focused
yeah,
shop? Is that
yeah.
right? Okay.
And you have other ones that just focus on BMW, for example, or Mercedes. It's a higher capex because there's more specialized tools, and then it's way more specialized labor. And so you can charge more and you can have higher margins, but you're much more. It's much more fragile. So if your one Euro guy leaves, it's a lot harder to hire a really strong Euro technician than it is just a generalist technician. And so as we were getting off the ground, if we had our first shop was a Euro shop and we lost that guy, we would have been dead in the water. So we kind of roll that in now, but still we try to, everything we do at one shop, we try to do across all the shops. And so that includes like tire mix, for example. You'll find a lot of shops that are very heavy tire, and then you'll find a lot of shops that sell no tire. And then
Hmm.
there's not a ton that sell a little bit of tire. And for us, it's like every one of our shops eventually will have a tire program. And so if it's a shop that is heavy tire, we'll supplement that revenue with other work and try to make that revenue less concentrated on tire. And if it's a shop that doesn't do any tire, we'll introduce a tire program and try to get that revenue up. So it's a long way of saying that we want every shop to look the same, but with some size stability, you can diversify a little bit.
Got it. Okay. That makes sense. What did you learn from your first acquisition that you either wanted to reproduce or didn't want to reproduce in kind of future acquisitions? Because, what I've noticed is that I can learn a lot about a new industry just through research and talking to mentors and talking to bankers, et cetera. And then once I buy into that industry, let's say my knowledge goes from 10 or 15% to like 90% in the first 6 months.
Yeah.
Was that a similar experience for you, or did you approach it a little differently?
Um. So I was. Let me think about that. So can we redo that? Can you ask the question again? Because I didn't know
Sure.
how to answer that yet.
Yeah. Um, one observation that I've had is when I'm going into a new industry, I can research a lot and I can talk to a lot of owners and bankers and get to know that industry. But then the day after I buy the business, or maybe 6 months after I own the business, I know 90% more than I knew when I
Yeah.
just researched the business. Was your experience similar? And what did you learn that you liked or didn't like from that first acquisition about the future acquisitions you were going to do?
Yeah, I think so. I think I'm more protected against that dynamic than most because I try to I generally think smart people way overanalyze things every day,
Amen.
particularly when they're doing deals. And
Yep.
I fell victim to this with the first version of business. I wrote a 90-page private placement memorandum and I read a bunch of IBIS reports and like did a deep dive. And the reason I don't do that anymore, and the reason all that time was wasted, was because of what you just said. It's that you can you just need like a general thesis, and then a lot, if not most of what you learn is going to be after you have the business and you're really operating. And so on this, I was pretty clear about certain things about the industry that hasn't changed. So I knew it was pretty recession resilient. I knew it's a mostly non-discretionary spend. It's very unconcentrated customer base. There's a lot of these out there. There's a lot of these great things about the business. Vehicles are aging, and it didn't take a lot of research to know that, and none of that changed. If it all, I think exactly about those things as I did back then. What I didn't research and left kind of undeveloped was how to manage these. How sensitive are the customers and employees to a transition, and and so I didn't really know because I knew I would figure that out. So no matter what I thought of before I bought a first shop, I would, that it wouldn't matter because whatever happens happened. And I've been pleasantly surprised on all those things, which is one of the merits of this strategy. Is all that stuff is it's hard. It's like really hard to operate these. This is a hard business to roll up, and but again it's a good fit for me. It's a good fit for the team I put together, and we've become really excellent at it, which gives us an advantage. But none of that's been a big surprise or much different than I thought going in.
Got it. What are some red flags that you have identified, or when you're looking at a new business, here's like a few things that I'd be careful of if I was buying an auto shop.
Yeah, it's all the same stuff for I mean search fund type deals or holdco type deals. It's just how important is the seller to the business? That's like number one, and it's really tough to get that in diligence unless you know exactly what to look for, whether it's an auto or another business. And because a lot of the times the seller is being honest with you, but even they don't fully appreciate how important they are to the business.
Right.
And to the business,
It's
I
all
mean,
muscle memory by
it's all
then.
muscle memory. And
Yeah.
by the business, I mean customers and employees. And so we know what has gone wrong for us, and so we know exactly what to look for specifically in this industry, which probably would carry over to others. Like we ask all the right questions of how involved you are, how sticky are the customers, like how much are you intermediate between the customers and the other employees in the business, like all these things. That's like the number one. The other things that have popped up that have really been bad are stuff that we just couldn't anticipate in diligence, and so I think we've gotten better at getting a sense for it, but it's things like sellers aggressively competing against you in violation of their non-compete, uh,
Mm,
that kind of stuff.
that's
The other
brutal.
one that we didn't look for, we bought a lot of real estate and roofs. So so we wouldn't do like a deep dive on the condition of the roof and or the business. And I mean that takes some extra spend in the upfront is to assess these things. But doesn't take a lot of $200,000 roofs that you have to pay out of pocket to get you focused on that. And so there's a couple capex items like that, that we look for now. But the rest is just the quality of the business, and we've gotten really good at identifying that.
The transition piece seems like a really important one, both for retaining customers, retaining employees. What are some best practices that you all have learned? And I think there's many different methodologies to it. So I'm curious, what has worked for you?
Yeah, it's again, I think this anything we've observed probably applies to all these types of businesses, on that point, and it's just trying to get in front of them early. There's a lot of negotiation involved in that. I know there are some sellers in other industries that you can't, like the first time you're meeting the employees is after the transaction's closed, and that just doesn't work for us. And you don't want to do
We've
it
made
too
that
early.
mistake.
Yeah, and sometimes, I mean, honestly, sometimes you literally have no choice. If you really want that business, then you got to concede that because that might be a deal breaker for a seller. But for us, it's not. Um, it never has been. And on the second deal I did, that was the case. And I met those guys as the seller was announcing the sale, and I was in the room, and it was rough. So it's getting in front of them early. It's talking to them. It's showing them your track record. You know, we do announcements, and we'll discuss, our retention rate. Basically, it's like we never fire people as part of a transition. We don't change a lot of the stuff on how they're compensated. In most cases, we give raises right off the rip. Um, so it's just communicating that, and then it's
Yep.
also knowing that, no matter how strong of a case you make or how good your track record is, and or what that employee is saying when you're delivering that news, you never know what's in their brain or their heart. Because like I think almost every time everyone's like, "Okay, glad to meet you. Yeah, great," and then whatever happens happens. And so some of the people that have quit right away or caused us issues were the ones that it seemed like they were totally fine with it. And so it's important to know that you just never know. So you
Yeah.
have to assess the risk there, knowing that.
So some transition best practices, try to get to employees and even customers maybe early, share about your track record, especially now that you guys have a track record. Some things that you guys like to highlight are not changing comp, you don't fire people as part of the transition. Did I get that pretty right?
Yeah. And customer, I didn't say that, but that's an important point. So we'll identify in diligence who the key customers are. We'll assess the risk of them, of losing them in a transition, and if it's a high risk, high important customer, then we'll have the seller interface with that customer prior to a sale and try to do a warm handoff, and we've been very successful doing that. Because in the past, when we've lost customers and we've really dug in, it you know the it we kind of figured out that if we had just done a phone call 2 weeks before the sale, then we would have totally kept them. And so, because there's a lot going on deals. There's a lot of stuff, and it's really easy to drop balls here and there. Even if they're a simple phone call, it's easy to forget that, and sometimes it'll cost you like 10% of your revenue. So it's really, being hyper diligent, and disciplined on your diligence list and your transition list, and hitting everything and not missing it.
How did you fund and structure your first deal? And this was it seems seemingly your first acquisition. Maybe you're a few years out of business school. How'd you get that one done and kind of get the momentum going? Because I know it's something that a lot
Yeah,
of people are curious about.
yeah, that was SBA debt. Just like most people use SBA, 7A program. We had real estate in there, so we got better terms. That was, and we about 90% levered. So we don't. That's kind of crazy, right? If you're buying a business and you're kind of getting off the ground on a search fund or something, I mean, I would take 120% leverage if they offered it to me. just because liquidity is there's not a lot of liquidity. You're trying not to get diluted. You're willing to take the risk. But
Yep.
if you say that to the guy that's done a lot of deals or bigger deals, like we're going to put 90% debt on this deal, it's like that's crazy. But I think that's kind of what you got to do if you want to retain ownership and get off the ground. And
Yeah.
so we did that, and then I took a very small equity check from two close friends and business mentors of mine.
Got it. So you took a SBA loan, you probably personally guaranteed it. Was it 7A or was it the 504 program for the real estate piece?
We ended up doing 504 for some subsequent deals, but that was 7A.
Okay. Got it. Yeah, that's how we got out the gate too. We used SBA loan for our first couple of businesses and raised a little bit of outside equity as well. So, um,
It's an amazing
there's
program. Yeah,
it's an amazing program. I think it's one of the most interesting economic engines in the U.S. that's funded by the government, and it just works. Government doesn't lose money; they make money on it, which is unheard of, and it keeps all of these communities and businesses in in uh, in business, basically, right? There wouldn't be any buyers without the SBA, is my
agree.
sense.
And the way it's used for these types of deals is not how that was not really contemplated when they created that program. At least by my read on it, and it's been used for this. I think there for a while there, maybe even recently, there was risk of the regulation or legislation being tightened up in a way where you couldn't use it for this type of thing. But I think we're past that. They've issued some revisions to it, and it's all seems pretty favorable. But you just got to understand, like you outgrow that. If your business is doing well, you're going to outgrow SBA pretty quickly. The drawback is it just takes forever. You're dealing with you still have to go to a bank, and depending on the quality of the bank, um, the deal could be really at risk or slowed down, and it could be a giant pain in the butt. And so you kind of face that, right? Like you hear stories with some people that they got a really great bank and they got a deal done really quickly, and it wasn't that much of a hassle, but that was not my experience. And so but it's really cheap debt, and it's high leverage, no covenants. But if your business is really going and you want to acquire, you got to have a plan pretty quickly on how you're going to recap that out or refi that out with other debt options that became available as you grow.
Yeah, and I'd like to ask you a couple questions about the scale up piece of the roll up business. But do you remember what the approximate kind of like revenue or profitability was of that business of the first one, and kind of like approximately what multiple you paid?
Yeah, that business was about 1.2 million in revenue.
Hmm.
Um, EBITDA was probably somewhere between 15 and 20% on that business. And then the multiple is hard to calculate because it was real estate. The real estate was part of that. So if you include the real estate assets, the multiple was incredibly high. And it's hard to value real estate, but it was, healthy. It's not that low, I'd say, but not that high. It kind of really down the fairway of what you would expect from any sort of small business doing 1.2 million.
Okay, that sounds good. And how many technicians or like mechanics did they have working there?
That one had five. That one,
Okay.
including kind of junior. That one had five. It had two service advisors on the counter, and then it came with a general manager, and so fairly small.
And is that have you found that to be a good size business to acquire? Are you looking for businesses with more mechanics or less mechanics? What has been kind of a strategy for you guys?
That's not. I mean, it's down the fairway. It's on the lower end. I'd say like
Mhm.
we're definitely buying larger shops now that come with more staff. But still, that's a good sized business. I mean, in some of the early subsequent deals were smaller, and they were just too small. Um, but if you're a shop, if you're looking at a shop and the seller is not that involved in the business and it's doing over 1 million in revenue, um, and it's not a lot of tire because tire has smaller margins, then it's a pretty robust business.
Hmm. That's great insight. And so tell me, or maybe like educate me a little bit on what happens when one scales up from SBA. Say you've maxed out SBA 7A, you've maxed out 504, you have a little portfolio going, and you're thinking to yourself, okay, I want to go from two businesses or five businesses up to 50 businesses. How how should somebody think about financing those, or how did you go about financing that transition?
Yeah, so I think the rules of thumb, and maybe they've changed, but as of recently, it was when you're about 3 million of financeable EBITDA. That's when you can start accessing um, junior capital or some version of like small senior debt to refi out SBA debt. That number may have changed, but as of a couple years ago, that's kind of the target where you can go to like regional lenders and start accessing that. And if you're, and by the way, if you're kind of at that size and you still have SBA powder left, like dry powder left, then still use that because that's going to be a cheaper option, higher leverage, no covenants. But if you're tapped out and you're kind of at 3 million of EBITDA, I think you're of good financeable EBITDA, which is different than like equity valuation EBITDA. Fewer add backs, like heavy focus on LTM, heavy focus on free cash flow conversion. Then that's the option. For us, we just did a lot of equity. So we tapped out on the SBA. We ended up starting to sell real estate out into the market on a sale leaseback, and then we had access to more equity at stepped up valuations. So we went even today we don't have any debt. We just raised a ton of equity, which is a strategy. I mean, equity is very expensive compared to debt, but it gives you more flexibility, it gives you more stability, security in the business. So it's always a trade off that's really bespoke to the opportunity you have. And for us, we view this as a multi-billion-dollar opportunity. So over equitizing and de-risking the business early was the strategy we employed. Contra to what I said earlier about if you're trying to get off the ground, 90% leverage is great. As you start having something of value, you want to delever. Like you don't want to have a business that's like high value with 90% leverage. It's just very risky, and like
Yeah.
a lot of little things out of your control can happen to just sink your business. So you definitely don't want to carry that leverage amount very long. And then if you have access to equity, it might be expensive, but I find that people are probably too dilution sensitive in the grander scheme of things. It's the adage like a small piece of a larger pie might be more valuable than a big piece of a small pie, and certainly a huge piece of zero. and so
Hmm.
you and you just have a very sober view of how much risk you're taking on with debt, and versus how much risk you're taking off the business if you're equitizing. That's a whole other discussion, but and I didn't know that, by the way. This has been through very heavy counseling from my investors and mentors, because it's kind of counterintuitive as a early stage founder who's like all in on the business. You have a vision, you can taste it, you know where it's going. I'm gonna lever the shit out of this because I want to hold on to my as much as possible. It takes like really smart people that have been through bankruptcies and distress situations to like remind you that anything can happen, and so you always have to be thoughtful of that.
Yeah. Yep. That's so true. As you're building up value, I'm sure the lack of debt removes some amount of stress and uncertainty, both for you and even for the acquisitions that you're doing. They know that this isn't a classic private equity over levered, perhaps business that might blow up if the winds change for a little bit, right?
Yeah, and look what
Um,
just happened. I mean, interest rates, I mean, dramatically increased with the tariff situation this year. The business community and the capital markets are like they don't know what's going to happen. And
mm,
and one of my investors always reminds me that Russia might use a nuclear device in Ukraine at any moment, and like that could happen tomorrow, totally out of your control. Like, what's that going to do to capital markets? What's that going to do to private investors that you may have access to today? What's that going to do to your exit forecasts? I mean, you don't. I guess if your downside case is that a nuke drops, then you're in good shape. But it could in this day and age, like you got to always be thinking about the survivability and stability of your business, particularly if your entire net worth like mine is in this business, right? I've like nothing other than this business. So it's very concentrated. It's not diversified. You gotta have a sober kind of view of that.
Yeah, yeah, we're 100% in agreement. We never take any guarantees or debt at our parent company level as well. So we're certainly aligned around that. The different ways that I've seen people raise capital for roll-ups are, one, maybe kind of like the classic private equity waterfall model, right? You're taking a management fee on the capital and you're getting a carry on the upside,
Mhm.
maybe an 80-20, 70-30, uh, and then it trickles down to maybe a bigger number to the general partner, the person doing the work. The other way that I've seen people do it is they set a valuation. Maybe it's a C corp, and they bring in investors who dilute them. Maybe there's a pref stack. Maybe it's all common equity, and then both kind of share in the upside. But there's no management fee and there's no carry dynamic. Did you do one of those formats, and which one did you lean to, and why?
Yeah, I tend to lean on in the direction of just simplicity and elegance on structure. So I mean, for us, we're a C corporation, and it's just a straight C corp. When we raise money, we sell common and preferred shares of the business, and that's it. And so, and when I raised money, even the small amount of committed capital at the onset, it was at stepped up valuation. So, and it was truly like a model. What's our equity value today? Maybe we get full credit for stuff that's in the pipeline. Maybe we don't, and try to come with like what's the actual equity value today? How much money are we taking, and just come up with a share count, and then we acquire some shops, kind of update, and then do another valuation. And we need more capital. What's the value today? Um, and that worked for us. I don't want to say that's the best way to do it. It's really simple now because we don't have any of this complicated structure. It's just who has preferred, who has common, who has warrants, and particularly as you get more valuable as a business like we have, when we did 2 rounds of institutional capital and at higher valuations, and same deal. It's just selling preferred shares, very simple, and we look like a normal company in that regard. I think
Yep.
I think the structure that you described. I'm not familiar with what's market. I mean, I understand what people have done. I understand the terms. The opportunity by doing that is to really give yourself a ton of upside, which is great. But what you give up is, if you don't hit your really aggressive like upside case, you're highly diluted, functionally, which I like because I'm a big risk taker. I love making those bets, and I'll do that all day long. Um, but I think it's just more complicated, and you run into weird incentives too. So if it becomes clear that your business is never going to hit the upside case, then you as an operator, or put yourselves in the shoes of an investor trying to keep their operator bought into the business. There's a lot of risk there, right? So if that person loses enthusiasm, and they see, hey, we're no longer on the upside case, I'm not going to make $100 million. I'm kind of going to be in the base or downside case for the next 5 years. Uh, they're not as strongly incentivized. But I like the way we do it because it's just kind of doesn't matter what case you're currently on. The economic split remains the same.
Right. Yeah. And our observation was, of course, with management fees, you're motivated to take on more capital. With the carry structure, you're motivated to maximize debt, right? Because you're mostly playing with house money. So if you go 90% or 100% debt, and it's easier for you to get into the carry
Yeah.
outcome, right? The juicy back end outcome. So
Well,
it can be a win for investors, or it can be it's much riskier for investors, which is the opposite of the business that you're running, really.
for sure. And my answer was just focusing on the dynamics around like a founder or an operator. I can talk a lot about my thoughts on carry and fund structures versus a C corp too, because I think that there are a lot of bad incentives that are introduced if you have carry, like kind of 2 and 20, like management fee carry. It's a very, like you said, it's a very strong incentive to raise and deploy capital, which you don't want to have. Like you want to have every incentive to be efficient with capital. and raise as little as possible and not be on a fun timeline. But on
Right.
these types of businesses, like that works on large businesses where you feel like you can flip it to another private equity firm. But all these kind of small businesses that we're talking about, you do not want to be on an artificial exit timeline, and you do not want to be incentivized to deploy capital at all.
Yeah.
So those are my thoughts.
I want to talk a little bit about team and culture in a moment. But first, can you mentioned this concept of sale leasebacks? Can you explain to someone who's never done it before what it means in the context of your deal, and maybe you can even give us an example of one of your deals?
Yeah, yeah. So sale leaseback is essentially you own a piece of real estate, you are operating a business on that real estate, you sell just the real estate to a buyer, and you concurrent with that you execute a lease. So your business remains on the real estate, but you no longer own it. You're just paying a rent. And the types of people that buy real estate are people that they're very yield focused. So how much money am I putting in, and how much money do I get for 20 or 40 years in the mailbox every day? And I'm not a real estate investor. But these people, it's a very safe, very easy, passive form of investment. And a lot of times the yield isn't really even that much higher than like bonds or treasuries. But it provides you an opportunity because the investors or the real estate buyers are yield focused. They're not as concerned about the like appraised value of the real estate or the underlying value, because they're doing a math problem on how much cash is going out, how much money am I getting in over time, what's my yield, and which is independent of what the real estate's quote unquote worth, like in a market capacity. Now it's important because if your business defaults, they now own this piece of real estate. They got to figure out if they can sell it to a developer or if they can find another tenant. Like it's important, but what it allows you to do is then you can kind of depending on how much rent you sell, to a buyer, what you're willing to commit to, that'll increase the price they're willing to pay for it. And I think these days are over, but when capitalization rates were really low, i.e., the yield that these investors were chasing were really low, you had a lot of roll-ups that were buying stuff, buying real estate and then selling it for millions and millions of dollars more than they bought it for. But then they're stuck for 20 or 40 years paying a really high rent amount, and that's what you give up for it. So, and your EBITDA is really low, like your earnings are really burdened by this rent expense. And so we still do sale leasebacks, but it's not really a core part of the strategy. When we first started, cap rates were really low, and we were producing some good cash, and that's what allowed us to take out the SBA debt, was the sale leasebacks of all these pieces of real estate
Oh
that we
wow,
that we
that's
had,
awesome.
you know. Um, but then interest rates went up, cap rates went up, and we as a company have been much more focused on earnings versus liquidity. Though, so our tolerance for high rents is much lower now. We don't really think about it too much, but it to us it's a source of financing, really, or it should be viewed as a type of financing. It's how much cash am I getting in today, and then what's the future stream of payments I need to make going forward. Um, and those early deals, we produce a lot of cash. I mean, I won't go into the numbers, but it was good. I think those days are over, and our business has outgrown that.
Yeah, that makes sense. What is your philosophy on owners post transition? Right, I know some people want to keep owners around. Some people say, "Hey, it's okay if you retire. I'm going to bring in a general manager or try to promote someone from within." Or some groups even have like a management training program at the
Mhm.
parent company. How do you guys think about it?
Yeah, pretty much as a rule, sellers go. We don't hire sellers. Former owners, as a rule. I mean, we've made exceptions to that. For sure, except for in extremely rare cases, like maybe once or twice, have we kept a seller in their shop, and it's strictly just a clash of culture, right? If you are a founder of a business, and this is very pronounced in auto because if it were like a white collar business, it's a little different. Like if you're a founder of an auto shop and you ran it for 20 years and you sat in that office for 20 years and you meet all the customers and you've hired everyone personally, no matter how good an idea someone else has that comes in, it's going to hurt to hear, and there's going to be just a natural inclination to push back and cross wires, and we've seen that. So keeping that guy there or gal there is always going to be a problem, which is why we don't do it. Now we have hired them as regional managers that sit above a bunch of shops. We've hired them as instructors. We've hired them as in various roles on the corporate team, and because that works great because you kind of remove them from their shop, but it's still pretty rare. Like the profile of these sellers is older or kind of heading into retirement, don't have a transition plan, so that's what they do. They take their couple $1,000,000 and they live a great life.
Yeah, that's helpful to know. I think we've also tried both, and we've mostly ended up in a similar situation where the owners retire, and either we promote someone from within or we're bringing in a manager from the outside. What's your philosophy on shared services? I know this is another
Yeah,
another area where people kind of go back and forth. What does your team structure look like at the
yeah,
parent company level? And what do you guys share across the different businesses?
yeah. So in this, I was going to mention this when we were discussing kind of the pros and cons of holdco structure. I'm a huge believer in having as quote unquote shared services as much as possible. Like anything that could be done outside of the brick and mortar, in my view, should be done in a back office. Like anything, if it's not like interacting with customers and fixing cars, I don't want my GMs worrying about it. Like I want my general managers and employees to be spending all their time with managing each other and dealing with the customer and turning wrenches and doing their job. And so I don't want to have them spend 2 seconds thinking about payroll or invoicing or marketing or except for as where it's appropriate. The problem with a holdco is if you do that, all these businesses are not really their own businesses anymore, like under your holdco, because you can't really sell a business or value a business if like a lot of core things it does is not in the business. So then you got to think about like, oh, I got to push down all this back into the business because before I can sell it. So that's a conflict. For us, we're not a holdco. We're just a C corp. So it's all together. It's all kind of in the same business. We have a whole 60 plus person corporate team here in our office, and our accounting team is a handful of people, and they do all the accounting for 100 shops, and our marketing team is a handful of people, and they do very advanced like unit level marketing strategies across all the shops. We have a full data team with a data engineer or multiple data engineers and a VP of data building out. I mean, continuing to build out our data infrastructure. On the deal team, we do all our in-house quality of earnings. There's a full team there. We have deal attorneys on staff because the other piece is like not only do I want it all back office, I want it all under my roof. And every whether it's a core competency or not, because we do the same thing over and over again, I want everybody to be here in our business. And when we launch, for example, you can't do that. Like you have limited capital, limited ability to attract talent. We had outsourced bookkeeping, we had outsourced marketing, we had outsourced data, outsourced FP&A, and as soon as we can afford it, we in-housed it, and we hire our own guys and gals and we fired the vendor, and we did all that. The final piece was the data team because that's a very expensive, like difficult thing to in-house, but we did it. Um, so anyway, I don't know if that answers your question. Like I'm obsessed with shared services as a version of shared services as you describe it, and I'm obsessed with in-housing it. It works really well with our structure. It's got a lot of drawbacks if you're doing it in a holdco structure.
Yeah, no, that's fascinating. I think that's a perfect answer, and I'm sure you get incredible efficiency. I'm sure you guys get supplier discounts too, right? Across your different shops, just being able to order across 100 different businesses. Is that fair?
Oh yeah, yeah, for sure. Yeah, I mean that's one of the returns to scale that you get with a consolidation is pricing power and on vendors and procurement.
Do you guys change the name usually to Main Street Auto Group when you take over a location, or are you usually keeping the local brand name?
We do a blend. So there's a tremendous amount of brand equity in these shops because we're only
Mhm.
targeting the highest quality assets in these neighborhoods. They've been around decades. I mean, we have some shops that were around in the 40s, and you don't want to. I think like a standard business school case would tell you you got to like switch the name on day one, and if you don't, it's going to create brand confusion, and employees are going to feel confused. And there's some truth to that, but you got to be really thoughtful. And so like the way we're doing it with these assets, they're brick and mortar locations that have been in the same spot for decades. You don't want to destroy that. So we keep the name, but we also introduce our name as part of a family. So it's part of the Main Street Auto family, and it allows us to put in marketing efforts behind like a unified name. We sponsor NASCAR, so we have a NASCAR on a number of races a year that has our
Fun.
branding on it, and so we get to do both at the same time. Yeah.
You're buying all these shops, of course, with each different owners, different employees, different locations, and I'm sure very different cultures. Culture is something you've brought up a couple times. So I'm curious, how do you think about culture? How do you think about unifying culture after you take over and kind of building this into one big cohesive company after an acquisition?
Yeah, culture is hard. I think it's like incredibly hard to change, which is why it's really important when you're starting to get it right and have it to be a good fit and genuine, because you can't I guess you can fake it for some amount of time, but if it's like faked or forced or disingenuous, then eventually it's going to fall apart. And so like that's why when you get off the ground, you want to be sure you're in a great industry for your fit, for like what how you like to act, what you say, how you carry yourself, how you want to manage people, um, making sure that fit is right, and then just being really genuine. And because then culture will build, and if you got to stay on top of it, because if you hire people that change the culture underneath you, like you don't keep an eye on it, or you're hiring the wrong people and you're adding toxicity or something, and if it goes on that way for some length of time, it's going to be really tough to bring it back. So you got to like protect it. So build it genuinely and then protect it. So you never have to change it. It's just the same thing. Uh, it's kind of a meta answer, but I think about that like very practically, because I mean it, because you got to really keep your ear to the ground, talk to people, understand how people view your business, how they view you, how they view what they're doing every day. Because if you you take your eye off that, particularly as we're hiring, like we have 850 people, if things can kind of veer off if you're not paying attention to it.
And are you guys doing some kind of on the ground training, whether head company people are going to individual locations or the GMs for the locations are coming to the head company? How are you getting that communication kind of back and forth?
Yeah. So on the training piece, we spend a lot of time, energy, and money on training. So we have a full learning and development staff. We have libraries of classes. We just moved to this office. The office that we were at prior, below us on the 25 floors below us, had, when we moved into it, had a great room, huge room with technology and everything, that we made our training and development room. And so we spent a lot of money flying general managers, regional managers, people throughout the business to get through iterations of training. When we moved into this office, we spent lots of money building the floor the way we want it. And one of the key things was a fully, like a large training room with all the technology and everything. And we want to use it because we paid for it. And so we get people out here. We um, do, it's an ongoing thing. So you give like the introductory training, then you give like recurring trainings on various things across the portfolio.
Yeah, that sounds great. What does the future look like for the business, Logan? Give us a little peek.
Yeah, I mean, continue to grow. I say, people sometimes don't believe this, but even before I bought the first shop, the vision was always to be, the biggest, most well known, most reputable automotive service brand in the country. And it was pretty obvious there's enough out there to buy. What wasn't obvious is like, can we build a great brand, culture, everything around it. That's it's hard to know in the early days if you can pull it off. But that vision hasn't changed. So if anything, we're 10 times more confident that we're going to achieve that now, having gotten from 0 to 100 and built all this, you know, the team, everything we got right now. So there's no timeline on it. I mean, I love what I do. The executive team loves what they do. No amount of money will change like how great of a job this is. So like we're just going to march towards that.
Yeah. How, just like, what is the sense of like speed that you guys are operating at now? How many companies are you either putting in offers on or acquiring in any given month or maybe 6 month period?
Yeah, we have enough in our LOI to do basically complete two transactions a week for indefinitely. I mean, between what's under LOI and what we got ready to put under LOI, that's the pace that we're going to achieve.
Wow. So you could potentially double or get close to doubling your number of locations over the next year.
Yeah, right now the bottleneck is capital. So like
Yeah.
there's basically three bottlenecks I would say that drive growth. What's responsible growth? One is number of deals out there to do, and there's a lot. That's not going to throttle us. Two is how fast can you efficiently and expertly integrate, and that's probably two a week, I'd say. And then third is capital. So if you're not constrained by the first two, like how much capital you have, and capital raising is very chunky, right? So it's a lot. You get a lot of capital, and then you deploy it, and then you're not raising incremental capital, and then you get a lot more capital, and we're right there at the cusp of a huge financing that'll remove that constriction, and then the bottleneck at that point will be operational, responsibility, like because you don't want to grow too fast.
Yep. Well, this is great, man. You guys are cooking with fire. I really appreciate you coming on the show today and sharing your story. I think it's an incredible playbook for other people to learn from and follow, and your story is a very special one. I'm so excited for your future. Bring you back to the show maybe next year when you guys have another 100 locations and see what you guys have learned through that process. If people are listening to this and they want to reach out to you, work with you, invest in your business, what are some good ways for them to either follow along or get in touch?
Yeah, I think LinkedIn's the best. I do my best. I do my best to read and respond to as many as I can on LinkedIn, but that's probably the best way to get a hold of me.
Okay. Awesome. Well, you heard it here. Thank you, Logan. I really appreciate you taking the time, and I'm sure we'll be chatting soon.